The U.S. economy is falling apart all around us. With inflation soaring to the highest level in 40 years, the central bank is trying to stay ahead of a potential hyperinflationary spike by rolling back its quantitative easing policies, initiating a taper, and introducing interest rate hikes. All of that indicates that a liquidity crunch is near. Even more worrisome than that, despite higher inflation and consumer spending levels, the economy also seems to be slowing down rather than speeding up or just maintaining the momentum from the prior year. The U.S. manufacturing end of the global economy seems to have stalled since around May 2020 and has never fully recovered from that point on. In fact, the new order flow for goods has decelerated to the lowest level in almost 4 years. On the other hand, every asset class in the country is nearing record highs, and the growing divide between unreliable expectations and our darkening reality means that risks are extremely high in the stock market. Right now, we're slowing down again from what was never really close to an actual boom, and many investors are going to learn that lesson the hard way. The massive disconnect between stock valuations and real economic growth is threatening to spark the worst financial disaster in our lifetime. And with the Federal Reserve on the verge of tightening monetary policy, that catastrophe is much closer than most people think. According to the financial and economic analyst Hugh Smith, this might be investors' last chance to get us out of the bubble before its inevitable explosion. Investors have missed the timing to get out of the rally several times in the past because the vast majority of them don't see or don't want to see the rising dangers until after the crash happens and causes very painful losses. But in Smith's view, every asset bubble has a last chance to get out before the crash point that becomes obvious in the aftermath. Today, this last opportunity to exit before the stock market crashes is exceedingly difficult to identify for a series of reasons. First and foremost is the extreme confidence investors have at the peak of the bubble that more gains are right ahead. Everyone who attempted to identify the top of the rally has been proven wrong, and everyone who shorted the rally, in other words, bet on a decline, has been wiped out, the analyst notes. Most market insiders are very cautious about the predictions they share publicly. All they say is that risk is elevated and a reckoning is looming, but everyone has heard this same sort of forecast for months or even years now. Smith highlights that the last chance to sell and start repositioning portfolio is not explicit. Technically, it's at best ambiguous, as all the conventional topping signals tend to be muddied, enabling bulls to declare the top is far from in and bearish signals have been nullified, he explains. The classic last chance follows an apparent breakout to new highs that exceeds previous resistance. In retrospect, the breakout proves to be false, but at the time it's clear to bulls that this is yet another breakout and therefore a reliable signal for more gains ahead, Smith adds. Everyone who sold when the bubble started to show signs of bursting is eager to get back in, so every dip in the market is reversed by the dip buyers who've been collecting huge profits from buying previous dips. In theory, even after conditions start to reverse in the broader market, the bubble can still reach a new peak and even a double peak, head and shoulders, if investors keep going all in the market. The rally that follows the beginning of a downward trend tends to exceed whatever levels were considered bearish triggers, so bullish investors have the deceiving notion that the market still has enough technical support to provide further gains. But that's when they miss the last chance to exit the market. They keep buying shares to fuel a rally that has already begun to falter. The buy the dippers ignore this decline and buy the second dip. That too falters, and once the third buy the dip has failed to rally back to previous highs, many buy the dippers have been wiped out, and the momentum of buying slackens, Smith continues. It's only when investors collectively realize that the buy-the-dip strategy has failed and will not work anymore that a major sell-off begins. turns into a self-reinforcing avalanche and the stock market finally crashes. Now, for those who want to believe that the rally will last forever, none of this is visible until it's too late to get out of the bubble with some profits in hand. Or as Smith puts it, by the time the banquet of consequences has been cleared, the majority of the believers in the inevitability of more gains just ahead have been wiped out by the crash that they reckoned was impossible. Right now, bulls are still thinking that fundamentals don't matter and the Fed will do everything in its power to prevent a collapse, while bears are still mumbling about elevated risk. However, the tech bubble has already popped. We have already witnessed the first dip, and soon traders will realize there's no way to keep reaching new highs anymore. This is not only a stock market bubble, but a bubble of everything. And this frenzy can only end in one of two ways. Either assets will stabilize for a significant period of time, allowing wages and the real economy to catch up, which could take decades, or the market is going to face an unprecedented meltdown. Needless to say, the first alternative is simply not realistic given today's inflation and exuberant stock valuations. The Fed has tried to delay the burst as much as possible, but now the situation has gotten out of their hands. Smith warns, the interesting feature of last chance to get out is nobody sees it until after the crash has done its damage. Only when it's too late does it become painfully obvious. Everywhere we look, we can find a series of indicators showing that this window is closing fast. But the problem is, most people don't want to look at the red flags. This month, the Fed is going to ramp up the speed of policy tightening and cut its support by a pace of $30 billion per month, as opposed to $15 billion. The first interest rate hike is coming shortly, and two more will follow thereafter. While inflation levels lie at the highest level since 1982 for 44.7 million Americans, a much bigger problem is about to hit their personal finances. The moratorium on student loan payments, collections, and interest, which was put in place in August 2020, is going to expire on January 31st. Now, given that in the U.S. financial system, this kind of debt is treated like commercial debt, must be paid regardless of income, all of these people's finances are going to be very compromised early in 2022. According to the Student Debt Crisis Center, 89% of U.S. graduates are not financially secure enough to restart payments this month. The average debt per graduate is $30,000, and the average interest rate is 5.8%. So the typical U.S. graduate is accumulating $1,740 of interest each year, with compound interest on top. This could trigger a disposable income collapse as people are forced to repay their debt. Meanwhile, the Consumer Confidence Index dropped in November from 111.6 points in October to 109.5 in November. So as more money is directed to debt repayment as opposed to spending, the short-term economic outlook only gets gloomier and gloomier. On top of that, there's still the housing crisis to consider. Often seen as the main indicator for consumer confidence, the housing market bubble is also hanging by a thread. Economists at Fannie Mae believe the median price of a previously owned home will hit $400,000 by the end of the year, while the national median wage is $34,248.45 a year. It's not hard to see what could go wrong when interest rates start to rise. All of this is scaring some veteran insiders who worry that the stock market will go from a zero interest rate to a zero alternative environment. Amongst them is the chief strategist at RIA Advisors, Lance Roberts, who recently warned his clients that, without exception, rate hiking campaigns led to a negative outcome. In an interview with CNBC, Roberts argued that even if stocks rise after the Fed raises interest rates, the aftershock will be much more aggressive than the upswing. While stocks rose 7% in 1999 after the Fed hiked rates, in 2000, when the Fed finished hiking rates, the stock market fell nearly 50%, he explained. One of the biggest consequences of rate hikes is the reduction of share buybacks that it causes, the strategist highlights. Share buybacks, when a company buys its own shares, potentially boosting its price and earnings per share, have been responsible for more than 40% of the market's return over the last decade, Roberts said, citing data from Bloomberg. Without share buybacks, the S&P 500 would currently be close to 2,800 instead of above 4,700, he added, stressing that with valuations this high, the market is particularly vulnerable to a sharp pullback. The last time we've seen such exuberant stock prices was during the peak of the dot-com bubble, and at this point, anything can derail the market. But Roberts exposes the top 10 threats signaling the arrival of a downturn. These are the combination of overvaluation plus tighter monetary policy, less liquidity in global markets as central banks around the world slow down accommodative policies, less liquidity in the economy as government stimulus fades, lower rates of consumption due to higher inflation, weak consumer confidence due to higher inflation, weak economic growth, weak earnings growth, weak year-over-year comparisons of most economic data, profit margin compression, and a flattening yield curve. Well, another threat the expert didn't mention is the new surge of virus cases all around the country. Hundreds of thousands of cases are being recorded every day. If the situation worsens and government officials start to reimpose lockdown orders and restrict business activity, a sell-off could begin much sooner than we think. Many other strategists agree with Roberts' predictions, including Bank of America's Savita Subramanian and Stifel's Barry Bannister. Today, the best-case scenario for the market seems to be the one in which the number of virus cases significantly drops. Inflation fades away by itself, rate hikes and tapering don't affect the economy or stocks, and consumers continue their strong spending. Needless to say, that's a lot of boxes that need to be checked. Only a miracle would bring back economic and financial conditions to somewhat normal levels to impede the looming stock market crash. This is a last chance to protect yourself from the disaster that is fast approaching. It's your choice to take it or risk losing everything. Thank you for watching Epic Economist.